Hello, welcome to all. In this video, we are going to discuss about divisional transfer pricing. Divisional transfer pricing. Why this is there? For this is main purpose is to motivate our divisionals. To motivate our divisionals. When, for example, if you take the any business and they have some divisionals, some internal divisions, and they will share their products to them, and sometimes what the company will declare, they will declare the in addition to their salaries they will give for bonus and based on profit. If division A transfers to division B some amount of and division B sells to outside, where here division B is transferring more to division B and division B is to outsiders. Here as we see the overall company we will not get the what division A to division B, we will not get any profit. From division B to outsider we will get the benefit, whatever the benefit arises. Here we will pay to the division A bonus and division B will demotivate. So to eliminate this demotivations or to encourage our divisionals, we introduce the chapter divisional transfer pricing. Okay, this is transfer pricing. And divisional transfer pricing overview will be concept, utility of transfer pricing, and international transfer pricing, it is last. And transfer pricing methods, there are some methods, they have actually three methods, and cost method we have another four methods, we will discuss later. Next, these methods show that behavioral consequences, that is they have proposal of resolving conflicts. We have two methods, one is dual rate transfer pricing system and another is two part transfer system. So we will use that in questions. Here what is their transfer pricing, why it was came, and internal division transactions would involve transfer of goods and services, payment of intangible assets, internal division, whatever we discussed, that is here they provided the example with diagrammatic expressions, raw materials division A, division B, and division B to external market, what we discussed is the example. Next, what are the utilities? Utilities are four utilities is there. One is performance evaluation and employee engagement and compensations, resource allocation and taxation and profit remittance. This is utilities, four utilities for transfer pricing. One is performance evaluation, we will evaluate the performance evaluation. So for division profitability, we will evaluate the performance of the division, what is the profit, accountable profit, and we will motivate each manager for to maximize the division profitability. It improves scope of company's overall profitability. Next, once performance evaluation is completed, next we will go for employee engagement and compensations. For managers, we will give compensations for performance of division. They are responsible when we give the compensations. When they give the compensations, they will responsible for that. And since transfer pricing influences financials, where transfer pricing are influencing, so we will pursue the to be fair all concerned division managers, we are transfer pricing unnecessary determination to division after affecting employee morals. Next, resource allocation, here we will coordinate among the units for production and sales. Production and sales enable better allocation and utilization of its resources, like what are the resources is there for companies, capacity, manpower, etc. And based on price, based on this price we will decide based on key decisions will arise from operations may be arise. For example, produce material in house or we will purchase from outside. Based on our resource allocation, we will get this answer, we will make or we will buy to expand our operations. The primary here aim is decision would be maximization of profit. So you must maximization of profit while also promote goal congruence among divisions. We will see in goal congruence later. Next, taxation and profit remittance. Here transfer price pricing will impact earning of multinational companies have internal division transfer. When we have a branch in other country, it will affect it will impact our earnings. This could affect the overall tax burden for the company as well as profit that may need repatriated to its head office. So when we are repatriating the profits, it will affect. Next, a question of fair value. What is the fair value means? Fair value means it is a arm's length price. Arm's length price is more for tax perspective. As in accounting records, we will see that in accounting record the transfer price will be supplying the whatever the supplying goods or services and cost for the division, and it will be profitable accountably, and any transactions between more business driven like customers and suppliers using bargaining power to set prices. Next, here we will provide one example for this. What is this example? Division A producing goods at cost of 10 rupees each and transfer goods to division B which has additional cost of 5 rupees. So it is receiving 10 rupees and incurring 5 rupees, and it is selling outside to 16 rupees. Next, the company has policy selling transfer price at cost 20%. So it is selling 10 plus 20%. It will be selling 12 rupees. So A is selling 12 rupees. Its cost was 10 and A's revenue was 12, and 10 minus 12 minus 10 means 2 rupees profit for division A purpose, and in division B we will purchasing at 12 rupees and we are incurring 5 rupees, so 17 rupees our cost, and we are selling at outside 16 rupees, so we are getting loss of 1 rupee. Next, overall profit. If you see the overall profit, we will get whatever the profit will be 1 rupee only, and division A is get, if you give the bonus for the profit based, division A will get more bonus and division B will not get any bonus. Now profit split between division A. Here 12 rupees does not affect the overall company profit since they get eliminated at time of consolidation. When we consolidating, it will affect the it will get eliminated the effect. Next, these records are useful for internal evaluation purposes and may not involve actual cash settlement. Here they will not involve any actual cash settlements. Therefore, transfer pricing methodology would greatly influence each division's financials, thereby underlining the need to have accurate measurement system. Next, here we will analyze the results. What is the analyzing results? Division A shows 2 rupees profit, while division B shows 1 rupee loss. Division A that incurs 2/3 of cost. So for cost it is incurring 10 rupees is it cost. So 2/3 of cost will be incurring, and 1/3 that is 5 rupees was incurring by B, 1/3 of cost, and where net profit margin 6.7%, that is 1 rupee 1 divided by 15, while internal markup the division A charges 20%, so it is charging 20% markup. Therefore division A will make profit. Division B will be internal markup at a much higher rate than markup it can charge its customers, therefore it will losing making benefits. So concept invents. Here behavior concepts will provide. What is that? Here manager of division B get demotivated since performance of unit is affected by higher internal markup. Due to higher internal markup, this division B is affecting, and division B manager will demotivated. So here since manager of division A will always make profit under this method, efforts may not be taken. If he, here A will not have any efforts and he is getting more profit. The management steps to review the following. First we will see the is transfer pricing of cost plus 20% is justifiable or not. We will see whatever the markup is adding, it is acceptable or not, justifiable or not, and what share of division A cost are controllable. What is the controllable cost for A, and is possible division A to take measures for cost efficiency and charge division B a lower amount. Is there any procedure? We will see. Next, alternatively division B be allowed to source the component from outside. So if division A, division B purchased from outside, what is the cost? We will see these three questions. So what is the first question? First, whatever he is adding, no, that is acceptable or not. Second one, is it possible, that is untolerable, or is there any method to reduce, that we'll see. And that is related to B side, A side. And B side, is there, if you purchase from outside, what is the cost? Next, transfer pricing methods. We have three methods, and the cost method we have four methods. That is transfer pricing, market based, and cost based, negotiation based. Cost based have marginal cost based, standard cost based, full cost based, cost plus markup based. Okay, here markup based transfer price. Markup based transfer price means transfer price is based on market price, where similar one transferred to internal within divisions. Here the recorded external market will be adjusted any cost by saved internal transfer. For example, selling, distribution expenses, packing charges, etc. What is the advantages? Since demand and supply determine market price, it is unbiased, and market price is less ambiguous compared to cost based pricing. They cannot manipulate it. Next, they cannot manipulate it because they are going with open market prices. So since the market price is competitive, divisional performance can be linked more objectively to its contribution to the company's overall profit. Next, what is the disadvantages? We have three advantages. What is the first disadvantage? We will unbiased to the demand and supply, and where market price is less ambiguous compared to cost based pricing. If you go for cost based pricing, we will charge only cost based, and they cannot be they can manipulate in cost based. So they will arrange. In case of market price, we cannot manipulate because the open market value is known for all. Next, since the pricing is competitive, so divisional price is linked with the more objective. Next, what are the disadvantages? Here three disadvantages. What is that? Market price may not be completely unbiased, where if competitive environment does not exist, if you do not have a competition, you will tell that this price is this much only, this price is this much only, then there is a problem of that. Next example could be distress sale market or manipulate price strategy like price determination. Next, may not be suitable when market price can fluctuate widely or quickly. So if it is a price is sharing widely and quickly, we cannot know which price is there at that time. Next, goods that are transferred may be at intermediate stage in the production process at time of market price may not be available to such intermediate goods, so they may be not available at the time of transferring. So these three disadvantages. When monopoly is there, it will distort the sale market price. Next, where fluctuating widely or quickly, it will affect. Next, not suitable, and goods transferred may be intermediate stage in the production process. Next, concept insight, behavior concepts. What is the behavior consequences? The existence of an external market promotes competitiveness within the entity. Both managers will be motivated to improve performance. The supplying division will have to compete with the outside vendors. That may lead to cost competitive operations. The purchasing division has more alternatives to choose from. However, the purchasing division must ensure that quality of goods is also comparatively. Generally, goods produced in-house may be as per specification. So here, when we purchasing from in-house, we will take the goods as per our specification. In outside, we will not get for a market price of where they, if you customize your product, if you purchase for customized product, they will not have open market prices. Next, share profit related to cost based transfer prices. Here cost based transfer prices, it is cost method, which is alternative to the market method, and here whatever the cost incurred by the division, it will be added to the product cost, and finally arrive the selling price of final product. Whatever cost you incur, it will be added to the cost, and it will be the final product. Here primary advantage will be allocate profit based on the proportion of value addition to the product in terms of cost. For example, market price and shared contribution method. So they provided two methods. First one is a manufacturer has two divisions, and one is corn flux and another is packing division. So it has two divisions. Okay, the production division purchases all cartons, so he is purchasing all cartons from packing divisions. So internal transfer is going there. Okay, cost of cartons from outside, if you purchase from outside, this is market price, this is market price related. So number of cartons will be 5000, 8000 units, then 77,000, and 8000 will be 95,000. Next, production cost incurred. Here production cost incurred. Production cost incur number of cartons, 5000, 75,000, 8000, 8000, 80,000. So it is related to cost method, that is cost based transfer price. So first one will be market price, next will be cost price, and next whatever the provided, whatever they produced and what amount they sell, that was provided, that is value 5000, 8000. Total cost was 1,20,000, 1,80,000, that is total cost. Next sale value will be 2 lakhs, 3 lakhs. Sale value will be 2 lakhs, 3 lakhs. So this is the sale value and total cost will be provided, and from this total cost excluded cost of cartons, that is if you purchase from internal or if you purchase from outside. Outside means market value, that was not there. Okay, appropriate transfer price being framed corporate management accountant. So okay, we will provide calculate transfer pricing based on share profit related method, that is cost method, and another one is market method. And in market method we will use the market price, and cost method we will use the cost price. And there may be that first we will calculate the profit, whatever the profit we have, and profit will be distributed according to their volumes. So first we will see the cost method. For cost method, 5000 units and 8000 units. What is the sale? Sale was provided 2 lakhs, 3 lakhs, and cost will be production division 1,20,000 and 1,80,000 for another one, and packing division, that is 75,000, 80,000. This is all are related cost. This is 1,20,000, 1,80,000, and 75,000, 80,000. This is cost. So this is cost. We are calculating cost method. This is our market prices. So we will add the cost, whatever the cost incurred. Total cost will be 1,95,000 and 2,60,000. Profit will be 5,000, 40,000. So profit will be 5,000, 40,000. Next step, to distribute this profit between the division based on cost. So we will distribute this based on cost incurred. So we will calculating in cost method, so we will distribute in cost incurred. Okay, distribution of profit based on relative cost. So what is the relative cost? We provided 1,20,000, 1,80,000, and cost related to packing division will be 75,000, 80,000. So we will distribute that. We will take the units into whatever the cost is there divided by total cost. Total cost was where we got this is total cost 1,95,000, 2,60,000. This is total cost. We will distribute based on that share of production division. For 5,000 and 40,000, profit will be distributed. If profit will be distributed, we will get the figures of share of production division and share of packing division. Share of production division and share of packing division. In okay, if you get this, what is the total profit? Total profit will not be changed because we are distributed the profit to production division and packing division, where they are transferring internal divisions is happening. Next, the last step is to calculate transfer price of cartoon that a packing division will charged by the production division. Here packing division what amount? We here production department is purchasing from packing division, so how much they are charging we will see. So production margin, packing charges cost was 191, this relative cost will be 1923, 12,308. Okay, 1923, 12,308. And manufacturing cost, how much we incurred, that is 75,000, 80,000 we will incur, that is cost we will incur is the provided data. Cost we will incur 75,000, 80,000, and they charged division packing division they charged by 1,923 and 1923, 12,308, and transfer price will be 76,923, 92,308. Transfer price per unit will be 15.38, 11.54, 11.54. Next, that is how we will get 76,923 divided by 5,000 units. Next, market price method. This is second method. For this second method, we will take the market price. We will take the market price. Statement of profitability market price method will be 5,000 units, 8,000 units, and packing division, production division. Here packing division was market price they provided, transfer price basis 77,000, 95,000, whatever they provided we will take. What amount they provided? They provided this amount 75,000, 77,000, 95,000, and for this amount. And what is the manufacturing cost? Manufacturing cost will be 75,000, 80,000. Okay, we will deduct this 77,000 minus 75,000 and 95,000 minus 80,000. We will get the profit of packing division. Profit of packing division. How much packing division they charge? They got the profit. We will see. And after that, here what we will get? 77,000 minus 75 means 2,000 profit. 95,000 minus 80 means 15,000 profit. Okay. What is the sales now? 2 lakhs, 3 lakhs. From 2 lakhs, we will deduct the transfer price, that is 77,000. We will deduct 1 lakh, whatever the cost we will get, and after that this cost, production cost. What is the production cost? 1 lakh 20, 1 lakh 80. So sales will be 2 lakhs, 3 lakhs, and production cost, product cost will be 77,000, 95,000, and product cost will be 1 lakh 20, 1 lakh 80, and we will get the profit. Let's see what is the profit will be provided here. What the profit will be 77,000, 75,000, 2,000 will be profit for packing division, and production division was 2 lakhs and market price 77,000, and product cost will be 1 lakh 20, and profit for production division will be 3,000, 25,000. Total company profit will be 5,000, 25,000. So profit will not change, and here transfer price may change differently, some marginally, because that 5,000 amounts, 5,000 units, they have similar amounts. So 77, 75, and 95,000, 80,000, they are some largely impacting, some marginally impacting for 8,000 units. For 5,000 units it will not affect much difference. Next, what is this provided? Let's see. For provided, and volume was 5,000 units, 8,000 units, market price cartoon 77,000, 95,000, and transfer price per cartoons based on the market price will be, so 77,000 divided by 5,000, 95,000 divided by 11.8, so 15.4, 11.78, 11.88. It is market based, and we will see the share cost based 15.38, 11.54, 15.38, 15.54. This is marginally difference, and where in 8,000 units it was 11.54 and 11.88. It is somehow some more. Next, analysis will be whatever we have observed, we will discuss about that. That is what we discussed under both methods. Distribution between division, that is differently we are distributed. For first case, we are calculated the product and profit will be allocated based on whatever the profit is there, we are calculated in costing method. And second method we are deducted directly to the manufacturing cost and market cost. Next, so it is different depending on the method followed. Consequently, transfer price units, the packing division charges, the production division will also be different. Here, where production volume is 5,000 cartoons, transfer price per unit approximately same. So they are same because under both methods 15.38 and 15.40 share profit and market price method respectively. And where the where this is because why the reason is because same, because volume is approximately same as outside procurement prices. While similar, when production volume is 8,000 cartons, transfer price will be shared slightly lower transfer price because lower profit as allocated the packing department. Where volume increases 8,000 cartons, in-house production is benefited from economies of scale. The cost of manufacturing one carton what is the cost of manufacturing one cartoon will be 15 rupees, will be 15 rupees. And here we will see that for the cost of manufacturing one cartoon is 15 rupees per unit for 5000 cartoons, that is 75,000 is the manufacturing cost, which is provided by uh, cost incurred, and if we see for 80,000 units divided by 80, it will be 10 rupees, reduced to 10 rupees, where volume was increased, then cost will be decreased. So cost reduction is almost 33% due to economies of scale. Next, on the other hand, at 8,000 carton value, the production department has not benefited much for economies of scale, because they are, when increasing the volume, the cost amount they are charging, the amount was decreasing, then we will not get the profit. Where packing cost, if we see the packing cost, what is the packing cost they provided? 1,20,000, 1,80,000. At the place of 1,20,000 divided by 8,000, that is packing cost will be 24, and marginally lower at 8,000 cartoons, 1,80,000 divided by 8,000 units, 22.5. So cost reduction is only 6% due to economies of scale. Next, therefore when production volume is 8,000 units out of total production cost 2,60,000. Next, major portion, the cost pertaining to production department. Major was purchasing for production department. Consequently, when profit get allocated based on cost, more profit has been allocated to the production department and lesser percentage to the packing department. So production will get more because it is a manufacturing unit, and packing will get less packing department. Hence the transfer price base is lower at 92,308, and under the share profit method, while market price method which it has 95,000, that is at 8,000 units. At 8,000 units, what we have, 95,000 will be the transfer price here, and it will have 92,398 transfer price. Next, cost based, will completed the answer na. Okay, cost based transfer price. What is cost based transfer price? And it is a method which is internal cost records of the company, and here management wants benchmark performance. Here what management was benchmark performance. Cost target, what is the cost target within the company, and alternative when market price is goods cannot be determined lack of comparable market. If you do not have outside, what is the cost, and they must reach the benchmark. Here cost based transfer price is considered. What is considered? Variable cost, share, standard cost, and full cost plus if there any markup, and therefore the basis for the cost price may be subject and to adapt based to its sustainability to the entity. What are the advantages and what are the disadvantages? Performance can be benched to the internal. Just a second here, I will see that what is happening. Okay, it's okay, correct. Advantages, disadvantages. What is the advantages for disadvantages for cost method? If you go for cost method, what is the advantages, what is the disadvantages? The advantages will be performance, we will see based on benchmark, so performance can be benchmarked to the internal cost target. Next, information is more easily available as compared to market price. So here information is low, their internal only, so we will get the information easily. Next, what is the disadvantages? Cost based, when you go for subjective, multiple ways of interpreting cost as where variable cost, standard cost, full cost, or some of these methods. Managers are not always agree on the basis to be followed, since which it will try to use the most beneficial for their decisions. So we have different types of costs, that is budgetary, standard, another. Which cost should be used? One manager tell one cost and one manager cost tell with another cost. Next, there will be problem. Next, since cost is passed to another division, here when manager of the supplying division may find little incentive to lower to the cost of production by adapting cost efficient method. If he adapted cost efficient method, who is sending the goods, he will get the little margin. Next, marginal cost method. What is this marginal cost method? It here we will add some margin, that is transfer price is recorded at marginal cost required to produce one additional unit. If you want to produce one additional unit, what is the cost? It will be added. Here advantage will be where supplying division has excessive capacity, and method ensures that supplying division recoup the cost of internal transfer, and while purchasing division enjoy the benefit of lower price. So here the beneficiary will be purchasing department. Sometimes they may ask in which method who will be benefit. In marginal cost, purchasing division will be benefit. Next, disadvantages. Here they will not add any fixed cost, and they will not add any markup allowed, and they will not purchase the divisions. In cost method, who will be benefit? We will see the benchmark. So ideally, who is sending the goods? That will be beneficiary in the cost method. And marginal cost method, who is purchasing, because they will not add any cost of any stuff, they will not add. So cost method, in marginal method, purchasing department will be a beneficiary. Behavior concept. In such a concept setup, profit evaluation is centralized at the entity level. Therefore, the supplying division may have little incentives to find the most cost efficient. Here, non-recovery of fixed cost will demotivate the supplying division. It may abort certain decisions like capacity expansion or forward. If you are not getting the incentives, you will not get the motivative. If you not get the motivative, you will not think broadly. If you are not think broadly, you will not go for expansions, and you will not go for infusion of investments, and if you lead the higher fixed cost. Next, another method, standard cost based transfer. Here, standard cost based transfer, where transfer price is recorded at predetermined cost. We will determine some cost, and that cost only used for this price. This cost is based on budgets and certain assumptions. This cost is based on some budget, and we will add some assumptions. They may be like for 2 months it will be increased 2 rupees, and budget will be 30 rupees. 30 plus 2, this is standard cost. We will use this standard cost. Whatever the cost we incur, whatever the profit is there, whatever the market price is there, we will not bother about that. So in standard cost, only what is the budget cost plus what are the assumptions for the factors like capital utilization, labor hours, what amount we are utilizing, what amount we are going to utilizing, that amount will be added. If there are any variances between cost observed using standard cost and actual, the is either observed by the supplying unit, or in some cases can be passed to the purchasing unit as well as. So based on assumptions, here the persons will be benefited. Here we will not tell who will be benefited. It is subjective based. It is a subjective based because they have some assumptions. Next, behavior consequences. Budgeted costs are generally based on historical records. So by how we will prepare the budgets, by we will take the last year profits and loss account, we will add some marginal amounts, and we will add some percentages, it will get some. So it is a previous books of accounts records data. Therefore little incentive exists to make cost more efficient to improve profitability. In previous year, what we can do, we will go for cost efficiency and we will go for improve profitability. So we will follow that only, we will not get the more benefit. Next, another method, Another method will be full cost based transfer price. Full cost based transfer price. Here whatever you produced, whatever he produced, what is the your full product cost, it will be included. And here what will be included for full cost, what is your production cost plus sale of other cost, and like selling, distribution, general overhead expenses, research and development, whatever cost you incurred, you will add to the product. Here advantages will be full cost of goods transferred is recovered, hence supplying division will not show loss. It will not get any loss. Whatever, if you are spending 100 rupees, you will getting 100 rupees. You are spending 1000 rupees, you will get the 1000 rupees. Next, disadvantages. Since markup cannot be charged on internal transfer, the supply division does not record any profit on the sales. So disincentives of for the supplying division. So if you are not adding any profit margin, you will not get more profits, then you will not get the more incentives. Next, cost plus markup based transfer price. Here the transfer price is based on full product cost, plus we will add some markup, the like 20% or 10% or 30%, some markup we will added, percentage of markup for cost or capital employed. Whatever the capital we employed, we will add on that amount. Next, what is the advantages, what is the disadvantage? Advantages will be here division make profits. Division will make, which is the supplying division will make profits. In cost plus markup, supplying division will be benefit, and in marginal cost method, purchasing division will be benefit. In cost method, the supplying division will be benefit, and in case of standard cost based method, it will be assumption based. So it will not tell who is benefit. Based on provided information, we will tell that who is beneficially. Next, supplying division will be benefit when cost plus markup, because he will have markup what he required. Next, this method addresses the disincentive problems discussed above to the full cost method. Next, disadvantages. Transfer price under this method could closely approximate its market prices, where purchasing divisions may bear a share of selling expenses, although none was incurred for such internal sales. Again, if you give for agents, for example selling distribution, if you have a agents of 10%, when they sell our product, we will give agent commission, we will add that in selling distribution. If you are selling for internal division, we do not have any agents, but the internal person who is purchasing, they will bearing that expenditure also. Next, behavior concept. Here the cost, the problem of fully cost, if you take that distort the company cost structure, and where the purchasing department variable one and proportionally purchase internally. And here the fixed cost, which is the fixed cost is always a sunk cost, it will be added. And market price purchasing division may calculated based on input supplied may slightly inflected, where if you have any special orders for purchasing division may typically be placed to meet short-term demands. If transfer price is quoted at below full cost, may be rejected because they could result in loss for supplying the division. So this is lead to sub-optimization of resources. Here what will happen, if you have any special orders from purchasing division, who is purchasing division, they have some special orders. For that they made some short-term demand. If your transfer price is quoted at a below full cost may be rejected because they could result in loss. If you not charged for full cost, if you incur 100 rupees and you are charging for 90 rupees, that means you are not if you are below full cost, then you will get rejected because you will get the loss for supplying the division. Next, if you transfer at 100 rupees and they will not have adding for them, then it will lead to sub optimization of resources. Fixed cost remains constant in short run, where fixed cost is for division A and division B has same cost, but division A is adding that cost to the division B, and while contribution margin for such special orders may have benefited the company as a whole. In such a case, management intervention has taken for goal congruence. So we will reach the goal congruence, management will decide. So fixed cost is for both the companies, so don't add A and B will add that. They will take that type of decisions at that place of time. Next, last method, negotiation based transfer price. Negotiation based transfer price means here this go between market and cost method. Where managers purchasing and supplying division independently negotiate. They will independently negotiate, arrive at a mutual agreeable price. Sir, I will give 10 rupees. That person is there, no, you will purchase at 15 rupees and they will come immediately 13 rupees. That negotiable based transfer price. What is the advantage, what is the disadvantage? Advantages will be, it is managers are given autonomy to, yet they will provide the independence to deal the division. So autonomy to decide whether to purchase or from its sister units or other sources, or source then from external market. Next, disadvantages. What is the disadvantage? This method requires sufficient external information to be available when you are negotiating. What is the outside? If you outside is 15 rupees, we will go for 13 rupees. If you are outside is 12 rupees, we will go for 13 is our loss only. Next, behavior concept they will provided. Next, transfer pricing and goal congruence. Here goal congruence, here we will get two formulas, range formulas, that is range formulas. What is minimum price we will charge, what is maximum price we will charge, what is minimum transfer price we will determined by the supplying division, and what is the maximum transfer price determined by the purchasing division. It will be seen in transfer and goal congruence. Because since internal transfer pricing develop a competitive setting for managers, so each division they will have competitive and they will have performance targets. So they will achieve their goals. So for that goals achievement we have goal congruences, and it can lead to suboptimal utilization of resources. Whatever the resources you have, we will utilize properly. And in case of transfer pricing policy may be established to promote goal congruence. We will promote the goal congruence, where if we will provide that range for promoting goal congruence. For each division we will give the goal, and for that goal congruence we will achieve that goal. We will have goal congruence. For this promoting goal congruence we have a range. They must sell or purchase within this range. What is the minimum transfer price? Determined by the supplying division. That is, whatever you have additional cost, whatever the additional outlay cost, plus for the sending of this product to the your internal, what is your opportunity cost? We will add this additional outlay cost plus opportunity cost per unit. What is additional cost outlay? That is, what is the marginal cost plus any additional incidental cost incurred by the supplying division, that is storage, transportation, etc. Next, what is the opportunity cost? That is, due to this going benefit that foregoing by selling internally rather than externally. If you go for externally, we will get some amounts. What is that some amounts? We will add to the cost. So in minimum transfer price, additional outlay cost plus opportunity cost. And what is the maximum transfer price? Here determined by the purchasing division. Who is purchasing the division? How much price we can put for this product? That is, we will see the NMR or EBR, that is net marginal revenue and external buying price. Net marginal revenue and external buying price, whichever is lower will be calculated. For whichever is lower, net marginal revenue means what is the selling price and minus what is the purchasing. What is the marginal cost? What is the marginal revenue minus what is the marginal cost to the purchasing division? Here purchasing division will calculate this type. And for these two methods, they provided one example. Division A transfers goods to Division B. Okay, Division A incurs marginal cost of 10 rupees and Division B incurs marginal cost of 5 rupees to process it for further. And Division B sells finished product externally at 20 rupees. So total cost for A will be 10 rupees and B will be 10 plus 5 15 rupees, and it is selling at 20 rupees. Okay. Next, to promote goal congruence. To promote goal congruence, what is required? Minimum and maximum. Minimum for supplying division. Minimum for supplying division. Maximum for purchasing division. Maximum for purchasing division. Okay. What should be the minimum transfer price that division A? Division A is transferring. Division A is transferring. That is supplying. Supplying will calculate minimum. They will treat like we will sell this product minimum this much this will sell minimum this much. That is supplying mentality. What is the purchasing mentality? Purchasing mentality will be we will purchase the product which we will maximum transfer price which can be transferable, which is less to the market prices. That they will the mentality of purchasing division. When you are purchasing, your mentality will be maximum this much we will purchase and in case of supplying division, minimum this amount we can get. When you are spending, maximum we will see. When you are getting, minimum we will see. That is the case. Next, minimum transfer price, that division A, that is supplying division will go for minimum. When you are supplying, we will get the amount. When you are getting amount, we will see minimum this amount will require me. And when you are spending maximum I will spend this amount. We will not spend this more than this amount. That type of mentality is there for this divisions always. Next, what is should be the minimum transfer price for that division A should charge, and assume there is no external market for this intermediate product. If you do not have internal price, then minimum recovery will be whatever the cost incur, that will be minimum. That is marginal cost. What is the marginal cost? 10 rupees. 10 rupee will be the minimum recovery need by division A. It is incurred. Next question. If division B can buy intermediate part externally. So if you buy from outside, there we will get 14 rupees 18 rupees 14 rupees or 18 rupees. Next, what should be the maximum price? So buy is giving price. So what their mentality? We will spend this much amount, we will not go for behind this. That is the mentality for B. So to be maximum price, that division A can charge the remaining competitive with, and we will compare with market price. If we will have for spending 15 rupees in internally, and we will getting for 14 rupees, it is better for go for 14 rupees only. No, so we will see that amounts also. For this, what is the our marginal for minimum was 10 rupees what is completed, and where maximum was, what is the marginal revenue? We will see the marginal revenue. What is the profit we will get? I think 20 rupees they told, no? Yes, 20 rupees. 20 rupees is marginal revenue. And what is the marginal cost we are investing? 5 rupees. So 5 rupees. So 15 rupees is the amount which is provided. This is net marginal revenue. What is the formula? Lower of NMR and EBR. So net marginal revenue and external buying price. So we got the net marginal revenue. What is the net marginal revenue? Marginal revenue minus marginal cost. Marginal revenue will be 20. Marginal cost, division B is putting 5 rupees. So 15 rupees. We maximum 15 rupees or division B, what are the amount? Whichever is lower will be taken. In first case, 15 or 14. We will go for outside, then it is benefit. If you purchase intermediately, B will get higher loss. Next, if you have market price 18 rupees, then it is better for purchasing 15 rupees. Then and 15 rupees. Next, assume that intermediate goods or division A can be sold externally at 12 rupees per unit. So intermediate goods were sold externally 12 rupees we will get. Okay, and how does opportunity cost affect the transfer price ranging when division B can procure the parts externally 14 rupees. So externally A can sell externally 12 rupees and their buying price is 14 rupees. So we will see the what is the minimum transfer price, what is the minimum transfer price, then we will get that. Next answer will be first tabulating the information. Transfer price provided, transfer price we will calculate transfer price. Okay, for marginal cost for A will be minimum recovery needed for division A will be 10 rupees and minus 5 it is total cost for division B 20 rupees, selling price will be 20 rupees, net marginal revenue will be 20 minus 5 that is 15, higher transfer price will result in loss. Next here range will be calculated to promote goal congruence. For a range we have minimum and maximum. Minimum transfer price will be marginal cost per unit to division A and plus what is the cost plus opportunity cost. If you have any opportunity cost we will add, but we do not have any opportunity cost, so we will not add. So 10 rupees is the minimum transfer price. Note there is no opportunity cost here, hence minimum that division A will wish you to recovery will be the marginal cost that it incurs where is 10 rupees per unit. Next calculation of maximum transfer price. Maximum transfer price will be procure externally. Maximum price that is lower of NMR and EBR non net marginal revenue and external buying price. Net marginal revenue will be marginal revenue minus marginal cost 20 minus 5 that is 15 rupees and external buying price will be, what is the external buying price? They provided two different rate, 14 rupees one time and 15 rupees one time. 14 rupees one time and 15 rupees one time. And here what is the minimum price? 10 rupees is the minimum price, and if the amount is 14, then minimum will be 10, maximum will be 14. If your amount is 18, minimum will be 10 and maximum will be 15 rupees. Because we will calculate the 15 amount will be lower of NMR and external we will be C. Next you will see 10 rupees and 14 rupees will promote goal congruence, and where maximum price 18 rupees, if it is 18 rupees then 10-15 will promote goal congruence. Next Range when opportunity cost exists for division A. If the opportunity cost is exist for division A, we will add that amount also. That is third question. Intermediate division A can be sold externally at 12 rupees. So their cost was 10 rupees. And the external price will be 12 rupees. That is 2 rupees will be the opportunity cost. So now marginal cost 10 rupees plus opportunity cost 2 rupees, that is 12 rupees will be the minimum price became. And B for B it can purchase from externally 14 rupees. We are calculated 15 rupees, 15 or 14 whichever is lower, that is 14, and minimum will be 12, maximum will be 14 that can purchase. For third one, range when opportunity is exist 14 rupees, buy price in 14, division A can sell externally at 12 rupees. So minimum transfer price will be marginal cost plus whatever the opportunity cost we have. What is the opportunity cost? We have 12 rupees external sale price and we have margin cost, we incurred 10 rupees. So 2 rupees will be the profit. If we sell outside we will get the 2 rupees. That opportunity cost will be added to our cost. So opportunity cost plus marginal cost, it will become 12 rupees minimum price. Case 2, division B will be ready to maximum 14 rupees per unit, which in the buy in price, and subject to negotiation skills of manager of division B, the transfer price we can set between minimum will be 12, maximum will be 14. Here the ideal transfer price would be 12 rupees per unit. Division A he is able to achieve profitability at par with its external sales, while division B can procure it materials at much lower cost. So A is getting, if we sell at 12 rupees, A will get profit, and if we B purchased at less than 15 rupees, he will also get profit. Next, transfer pricing decision different circumstances. We will see in next class here.